Hello and good afternoon. My name is Gavin Maguire. I'm a senior equity analyst over here at briefing.com. I post under the event ticker. And today we're going to be talking about the Briefing Trader Election Playbook. I appreciate you guys joining me, and I will be looking to keep everything concise so we're not taking up too much of your day here and you can get back to the afternoon activities. But basically, we're just going to be taking a look through the upcoming elections, which obviously are going to be playing a large part in the economy and stock markets moving forward as we switch from out under the Obama administration into either the Clinton or the Trump administration. So, our goal of this is to try to keep this very unpolitical. There's money to be made with whoever will be taking over. So we just want to kind of take a look at how the markets are viewing everything at the moment and potential opportunities that could open up on both the long and short side, depending on who gets into office. So with that, we're just going to start moving ahead here, and we're going to take a look at the markets during election years. There wasn't a lot of rhyme or reason to how the market performed, but one of the underlying aspects of this was that, generally speaking, there was stock struggled in the first half of the year. Given the uncertainty that would lie ahead of an election, this makes sense. The markets would really find a bottom once a clear-cut winner emerged, and we haven't really seen that. And one of the possible reasons for that is because there's been larger issues at play with the global economy. We've had items like Brexit falling into place, and of course monetary policy too, which has taken up its share of impact on the markets. So, we haven't seen necessarily a bottom per se come into place, just rather a steady rise since February. So one pattern that did stick out that we might want to keep an eye on is that the 3-month return in markets ahead of the election had predicted 19 of the 22 outcomes since the 1928 election. S&P was at 2174 on August 1st, in case you were curious. That's using the continuous contract. So elections and recessions, this is one thing that was sticking out in my studies over it. There have been 14 recessions since 1928. 11 of them, or 79%, have started after elections, with a median average of 8 months and a mean average of 8.4 months. Given some of the uncertainty, potential for changeover in policies and everything, there is a chance that this could hold down business spending and keep businesses on the sidelines. So this is going to be something that we watch as we come into year 9 of the current bull market. A lot of people have been calling for recessions and everything. Not that this is a call for a recession, but it's something to keep in mind as we go into 2017, which is also going to be seeing a lot of impact from elections over in Europe as well, too. So one thing also to keep in mind is the Dow Jones ended higher 21 presidential terms. This is using the December after the election through November of the election. 3 of the 6 declines included the Great Depression, Carter's oil crisis, and Bush 43, the Great Recession. Hold on a second. We're just having a slight technical issue with the mics that we're going to try to get straightened out here.
All attendees are muted.
Okay, we're back. I apologize for that. There was a small technical issue, but so moving ahead. Okay, so basically what we're looking at is, we have an electoral voting system set up back by the Romans in early AD, and more or less it was just to kind of hold up against any sort of populist vote taking over. There's 270 electoral votes that are needed to win the presidency. And currently, Hillary Clinton has the easier path. It's just a breakdown of how some of the electoral votes go in terms of Democratic-heavy states like New York and California. 538 as of this morning had given Clinton an 82.9% chance of winning. Not looking to go off any particular one poll, but just kind of wanted to highlight how the market's looking at things right now, and that is for a Clinton victory, and that needs to be taken into consideration. Trump needs to simply carry more battleground states, which is extremely difficult to get a clean sweep. Here I've got a list of some of the battleground states that will be in play, but the three most important ones to watch going forward are going to be Ohio, Florida, and Pennsylvania. As you can see, the last Democrat to win without Ohio's John F. Kennedy. No Republican has won it without it ever. Right now, Trump is ahead by 2 points in some polls, but Clinton is given a 59% chance of winning by 5/38. Florida, the last Republican to win without it was Calvin Coolidge. Clinton's currently up 3 points in that with a 70% chance of winning. And Pennsylvania, Clinton has a pretty hefty 12-point lead there with an 86% chance of winning. So as you can see, the market's really shaping up for a Hillary Clinton win. Obviously, we want to be ready for anything. One thing I did want to address on that is the idea that we'd see a sell-off if Trump was indeed to upset and win the seat. I would agree with that aspect, but I think it would be something that would open up a buying opportunity, similar to what we saw with the Brexit vote and when we saw the big decline following that surprise. And I'm going to move forward with that and show you some of the reasons behind that. So one of the key things to keep in mind with any of these people that they could get into the presidency is how Congress goes. With the Obama administration, he's been in, but he's been going up against the GOP Congress that's kept him from getting some of his policies moved through, and that needs to be watched. The Senate is probably the most up for grabs here, as the Democrats need to take 6 seats to gain control. Currently, there's 10 Democratic seats open and 24 Republican seats open in the next election. I've listed some of the key states that are going to be following. Right now, 538 actually is giving the Democrats a slight lead in getting the control of the Senate. Congress, though, is likely to stay under Republican control. The Democrats need to take 30 seats, which is going to be extremely difficult. So as you can see, there is going to be a baseline scenario for balanced power that maintains the current split in power. Okay, so let's see if Trump does win. Here's a list of some of the major winners and losers that we'd be looking at potentially under a Trump presidency. Oil and gas, just from lifting some of the regulations. Aerospace and defense, as Mr. Trump has said that he would look to increase spending here. Materials, because both candidates are looking at infrastructure plays. Domestic manufacturing, from the idea that he'd be looking to bring jobs home. Multinationals on a repatriation view. Coal, again, on regulation. And volatility, just because under a new presidency with a lot of uncertainty, that would certainly increase that dynamic. Some of the minor winners could be pharma and biotech, again, on the regulation front, and potential changes to Obamacare. Medical devices, utilities, financials under, again, less regulation. Moving on to some of the major losers, healthcare providers would be one of the areas that people would be looking at given changes, again, to Obamacare. All right, under Clinton, some of the winners and losers. Solar, wind, alt energy, that's become a focal point of her infrastructure spend. Materials, again, under infrastructure. Healthcare facilities and services, once again, under Obamacare. Aerospace and defense, Ms. Clinton has also been supportive of defense spending. Consumer staples, because of differences in their trade policies. And technical and telecom, which is areas where she would be looking to spend as well. Oil and gas, MLPs, student lenders, prison operators, and big banks are all regulation issues that could be hit by a Clinton presidency. And, of course, coal and pharma and restaurants when looking at minimum wage. So, taking a look at some of the different policies, we've got infrastructure. Both candidates would be a positive, as both of them are looking to spend money in order to build the economy and stimulate. Positive across the board for the markets. How they're going to go about it is a little bit different. Ms. Clinton has proposed spending approximately $1.55 trillion over 10 years, financed through taxes on the wealthy and corporations. Her focus would be on highways, public transports, airports, and green energy. One other key item that she's talked about is getting affordable broadband in every house by 2020, which could really bring in some telecom structure plays, which we'll talk about in a little bit. Under Mr. Trump, he's proposed spending approximately $1 trillion and reducing spending, reducing spending in some areas, which leaves the spending gap to be largely financed through Treasury debt. The method of increasing the debt could potentially weigh on the dollar and bonds, so that's going to be something we'll have to keep an eye on. Also, to cut in taxes and increase spending could steepen the yield curve. Another bonus for financials, but something we'll touch upon a little bit later. Okay, one of the big differences that we're going to need to take a look at that could have the most immediate impact on markets is capital gains taxes. So taking a look at it under these two candidates, Ms. Clinton has put forth increasing the federal capital gains tax with a marginal tax rate of 47.4%. So basically, after 2 years of holding an investment, the rate would slowly start to decrease. The lowest rate of 20% would be hit on a 6-year hold. Currently, that's at 1 year. Something like this could reduce liquidity, and we're also going to take a look at how it could potentially impact some end-of-the-year selling as people will look to unload some gains following a 5-6 year run in the markets to lock in some tax to avoid some tax payments. Mr. Trump, on the other hand, he hasn't released the full details, but expectations are for him to lower the rate on the capital gains tax. There's also the repeal of the 3.8% surcharge for the Affordable Care Act, which would likely go into play. So that would be something that would maybe keep people in the markets for a little bit longer, and kind of brings us back to the idea that the market would just naturally sell off under Mr. Trump. This could open up some opportunities as people look to take advantage of a potential bounce and tax purposes as well. So again, under the Democrats, would likely see some increased selling to lock in the winners. Republicans would likely see a delay in selling to capture a lower tax rate in the following year. The general idea being that momentum stocks under the Trump plan and value stocks would be kept under the Clinton plan. So that's something to keep in mind when we see probably the most immediate action, because as we're talking about, it might be difficult for some of the infrastructure spending and other ideas to be put into place, whereas these tax gains are something that could gain steam and be locked in towards the end of the year of 2017 and thus cause people to act in 2016. Okay, taking a look at some of the other tax policies. We got corporate taxes. Under Clinton, there's really no big plan to change. I know there's been talk that she could lower it, and that could certainly come into play. The current marginal corporate tax rate is 39%, but the effective tax rate is approximately 27% after deductions. One thing that she has made clear is that she looked to stop further tax inversions, which could weigh in on the M&A space. Also, it could be seen as a negative for multinationals with big overseas operations, as she looks to potentially tax further into some of the overseas monies that are being held. Corporate taxes are approximately 10% of revenue, if you're curious, and less than 2% of GDP. So it might not have a massive effect on the overall economy, but obviously some of the different corporations that would be impacted by this would be in play. Under Trump, he's talked about lowering the corporate tax rate to 15% from 35%. If curious, President Obama himself has called for it to be lowered to 27%. Trump would eliminate loopholes and tax exemptions, but he has not clearly stated what changes would occur here. Also, there's talk of a one-time repatriation of 10% of earnings and an end to deferrals of taxes on foreign-owned holdings. This would be an obvious boost for multinationals. A few that come to mind would be Apple, Google, Cisco, Ralph Lauren, Microsoft, General Electric, Gilead Sciences. These are some of the names that we'll be discussing shortly here. Okay, then trade. This is another area that's going to be very key for the markets, and probably one of the biggest reasons why we'll see some selling pressure under Trump initially, and then probably early into 2017. Mr. Trump has obviously used anti-trade as a pillar of his platform and has promised to rip up the Trans-Pacific Partnership and NAFTA. Clinton has also been supportive of global trade in the past. She supported TPP, and of course, her husband Bill Clinton created NAFTA. But she did take up the anti-trade platform following Bernie Sanders' success in the primaries. NAFTA is, of course, Mexico and Canada. The TPP is 12 Pacific Rim countries and also includes Canada and Mexico. Both candidates have said that they would look to take a tougher stance on China. So, free trade has increased competition and lowered prices. So a move away from this could prove to be inflationary. It's two areas you're going to want to keep an eye on as we move forward with the trade talks. Gold could also see a double interest as a potential alternative currency, given all the dollar-weighted trade that's in play. Some of the export-reliant areas that could be hit on any potential trades is the emerging markets, which here I've included EWW, which is Mexico, EWC, which is Canada, and EEM, which is the emerging market ETF. Our three largest trading partners are China, Canada, and Mexico, which make up approximately 45% of U.S. exports and imports, obvious areas that we're going to watch. Aircraft, auto, soybeans, industrial machines, computers, and semiconductors are 49% of U.S. exports to China in 2015. So if there's an idea that we're going to be putting on tariffs on China, we could see a tit-for-tat scenario where China also looks to put on some tariffs on our technical exports. Keeping in line with the trade, aerospace is our largest export industry. Gross exports were $119 billion in 2015. The Asia-Pacific area also makes up about a third of global travel. China, as we said, could respond with its own tariffs and make up 13% of exports. In auto, another area where companies have been looking to redistribute manufacturing. Obviously, you've heard a lot of talk about Ford moving jobs over there in the Trump speeches. That's up for argument. There's still a lot of jobs that are created at home, but these are areas of concern under any changes to the trade scenario. So taking a look at that, China exports no cars to the U.S., but imports approximately $19 billion. GM has approximately $2 billion in earnings through JVs, and Ford has approximately $1.5 billion in earnings overseas. Suppliers have been building up presence in Mexico, and that could obviously be an issue if NAFTA was to be torn apart. You'd also look for companies that are running ABS transactions. I put Santander Consumer there, SC, just as a possible example. And again, this is arguably the biggest impact given the mobility to regionalization production. Oil, U.S. imports were approximately $60 billion or 33% from Canada and $14 billion, 18% from Mexico. U.S. exports to Canada were $17 billion or 6% and $16 billion or 7%. Refiners and producers could see potential reduced demand here. So this is another area where we're obviously going to have to keep an eye on under any changes to trade contracts. Basic industries, the chemical industry could again see a negative impact if they were targeted by China, given the amount of exports that they have out there. Positive for steel producers, though, as they would be protected by tariffs coming in. So we have U.S. Steel, Steel Dynamics, AKS, and Nucor as some of the names that we'd be looking at there. Technology, of course, a lot of the global supply chain has moved over to Asia, so we could see a rise in costs in some of these companies if tariffs were implemented abroad. So, taking a look at the financials, this is kind of a wash. I mean, obviously Trump would deregulate a lot, which would be viewed as a major positive, but there are other issues at play here. Clinton, of course, has been close with Elizabeth Warren in raising the regulation and capital needs for these industries, for the industry, which would be painful. But she has stopped short of Glass-Steagall as a potential play for that. So that's something to keep in mind. Ms. Clinton has also talked about charging a risk fee for excessive leverage, which could hit some of the bigger IB names out there, like a Goldman Sachs or a Morgan Stanley. There's also talk about the limited of executive bonuses, which could drain some of the talent out there. Trump has said that he would look to halt Dodd-Frank, which is approximately 70% implemented. Still 9% of the rules have been published and just awaiting clearance, and 20% of it is unproposed. However, he also has hinted at reinstating Glass-Steagall, which kind of puts, into question some of the benefits that he could serve for financials. Okay, taking a look at healthcare, which is probably where the two sides differ the most. Ms. Clinton's platform is to expand access to Obamacare, the Affordable Care Act, support insurance tax credits and a cap on premiums and deductibles, which would be negative for the insurance industry, obviously, expand Medicaid by lowering the age to 55 from 65, push for lower drug prices, and also the creation of a public insurance provider. Mr. Trump has obviously said that he would look to repeal the act and replace it with a market-based system, also remove some barriers on interstate insurance, allow the purchase of higher deductible healthcare savings plans, and deductible of insurance premiums for personal income tax. Taking a look at the healthcare insurers, it's pretty clear-cut. Trump would be positive, Clinton would be negative. Insurers have incurred the most amount of losses from the ACA, as they simply don't have control over some of the pricing and costs in the area. An expansion of Medicaid could also have employees pushed out of companies, meaning that instead of going on a company plan, the companies would look to push them more towards the federal plan. So this would be less people in the place for the insurers and the potential for less revenue, smaller revenue stream. Also, reducing out-of-pocket expenses would pressure insurers' ability to control costs and pricing. Under repeal, insurers could see a flood of members seeking health care before terminated. So that's another thing to keep in mind if Trump was to get into place, where it could set forth for a poor Q4 for some of these insurance companies. Excuse me. So taking a look at the health care service providers. Okay. Acute hospital care providers have been a big winner under ACA. Very simple, the reduction of bad debt expense. Excuse me. A change to Medicaid block grant would also be negative for the providers, especially under the nursing facilities. We'll be providing you some of these names here, but this is the one biggest positive for Clinton and a negative under Trump. Expansion of Medicaid could hurt the providers as it pays less than insurers. The number of uninsured rising impacts the bad debt expense. For medical devices, a Clinton win would be viewed as positive, as healthcare providers are the biggest customers of medical devices. So an impact of the ACA was repealed is not totally clear, but this could also be viewed as a negative, as there would be less money simply for healthcare providers to spend on medical devices. Also, another item to keep in mind is under the one of the things coming up is the Consolidated Appropriations Act, which is currently under a 2-year moratorium on medical device excise tax, which is 2.3%. It's expected to be reinstated under the ACA, which would obviously be a negative. But an item that we're going to want to watch is if Ms. Clinton does get into play, how Congress is going to be treating this. Okay, the pharma industry. These guys have faced the highest costs under ACA due to industry fees, a higher rebate for Medicaid beneficiaries, and a discount for Medicare Partner D plans. Both have discussed removing barriers to import drugs from foreign companies that can be provided at lower costs. So here's a couple of tickers that we're going to be watching in case this picks up steam and increases the competition among foreign providers, which could also impact the pharma companies as it could drive down pricing given the increase in competition. CMBS plays is another area where we're going to want to watch if pharma companies continue to see the revenues impacted and hurt by lower prices, as this could hurt in rents in different apartments and commercial space. So now we're going to take a look at some of the plays here. Basically, what I've done is list out the different industries and tickers that we're going to want to keep an eye on. These are all things that are going to be discussed on the site over the next month and a half and longer as the election cycle plays out, and we have a fair idea of what policies are going to be moved into play. But this, rather than just read them out to you, I'm just going to give you the quick overall view and allow you to kind of start putting this into a portfolio or a watch list for you to keep an eye on. The aerospace names, the XLI ETF, and I've some of the bigger names out there. We obviously have the Honeywell warning out there, which is impacting the space, but it could open up some opportunities as we see a pullback, given the weakness. I think some of the weakness can be attributed to just delays in spending until we had a fair idea of who was going to be in office. The auto, which we discussed under the potential for a change in trade. Industrials, which should benefit no matter who gets in office. Of course, we've seen a lot of these stocks run up ahead of time, so it's going to be something that we're going to probably be looking for a pullback, because one thing to keep in mind with industrials, the average spending under a new administration has gone up 5.5% year over year. And the idea that shovel-ready plans are going to be in place once somebody gets into office is a little short-sighted. There will be a time frame and a lag that should push a lot of these results into the 2018 time frame. So a lot of the stocks have run up, and the fundamentals will simply lag until 2018, which might set up a couple of shorting opportunities and pullbacks. But if you're a longer-term investor, these are names that you're going to want to be keeping an eye on and looking at investing in. Again, we'll be discussing this in greater detail on the site as we go along. Semiconductors, which we discussed, one of the items that we'll be keeping an eye on is who could be impacted by any changes to potential tariffs overseas. Steel, which obviously would be a big beneficiary of any imports, at least in the short term. Oil refineries, which we'll be looking at more from a regulatory process with a Trump win being a short-term positive. One of the items that's been brought up in the past has been that if regulation is slowly pulled back, that eventually we could see another overglut in oil supply, which could be a long-term negative. So that's just something to keep in mind. Chemicals, again, under the trade platform, if there's any changes here. Health insurers, which we discussed, would be a positive under Trump and a negative under Hillary. These would easily be the biggest winners if Trump was to surprise on November 8th. They're already near 52-week lows, and they kind of foreshadow the market expectations that Hillary would indeed be the next president. Healthcare service providers, again, a positive under Ms. Clinton. These guys have been trending higher ahead of the election, kind of as another proxy under how the market sees the elections going. Medical devices, which will kind of trail the service providers, as these guys are the biggest customers for medical devices. Pharma, again, a healthcare platform that is going to need to be watched. A lot of these names, as we know, have been beaten up under some of the regulatory pricing environment, and will continue to be watched closely in the coming weeks. Coal, another big winner under Trump and loser under Ms. Clinton, given the divergence in regulatory policies. Alt energy would be a big winner under Ms. Clinton. Trump, probably more neutral. I don't see how he could just turn his back on the growing industry, but he has said that he is there to support fossil fuel, which would see some of these names under selling pressure. Financials, a bit neutral for both. This, I think, is going to be driven more by monetary policy moving forward anyway. Regulation is already in place. Capital levels are already strong. I don't see such an incremental change in the regulation that would impact these guys. Obviously, Glass-Steagall would be a game changer, but I think that would be difficult for that measure to pass. So that's going to be more of a monetary policy issue that you want to follow on, and overall strength of the economy too. Infrastructure, going to be a good place for either side. Some of the names that I was looking at is NVE, which is NVS Global, and Jacobs Engineering, which will be at the forefront as they provide consultation for a lot of these companies and would be at the early end of the winners. So taking a look, this is what I put together as the quote-unquote Clinton basket. These are the longs and the shorts that you're going to want to be looking at, and some of the reasons why. Some of the different spaces. One of the more interesting ones is the BlackRock Bond Fund, BBN, which I think could be a big winner under a Clinton presidency, just because it'll provide some tax shelter for people moving forward, and it is an infrastructure play on bonds. The Build America bonds is where this first started, and an area where I think you're going to see as a big winner under the Clinton presidency. One area that I wanted to put out as well for the short side is the private jailers, GEO and CXW, which have been in the news of late over concerns of funding. Ms. Clinton has said that she doesn't see the need for private funding, that nobody should profit from somebody being in jail. And on the flip side, you have Mr. Trump, who GEO also handles border security. So these are two names that are going to be in play that probably won't be getting the most publicity, but are going to be very tradable. Now we have the Trump basket, with some of the more notable longs being obviously the steel industry under the trade policies. We discussed some of the pharma names that would be big winners under a Trump and insurers, which would be a big winner under a Trump presidency. Volatility trades like the UVXY and the VIX would also be areas that you're going to want to watch, because there's going to be a lot of uncertainty, a lot of geopolitical concern under the initial reaction, and these are going to be areas that you're going to have to be in. For shorts, I'm just kind of looking at BA and UTX, more under the aerospace changes to trade and imports, and same with the autos. I think this is going to be areas where you're going to be wanting to watch. And of course, the healthcare providers is going to be another system that will be in flux under the uncertainty under under a Trump presidency. So that's going to conclude this presentation. I know it's a lot. I know it's a lot of tickers, but we are going to be providing this presentation for you to be able to download. I'll be providing more information on that. I also have an expanded presentation that was simply going to be running too long that I cut down that will provide some additional information that I will be providing a link to for anybody that's interested in that as well. Again, I know there was a lot of slides. I know there was a lot of material. So these presentations will be made available for you to have as a watch list, and we will also be discussing it in depth on the site moving forward as potential plays as we have more time to dig into these a little bit more in depth. I really appreciate everybody's participation in this. I do hope this was, I apologize for running a little bit over. I do hope that this was helpful and provided some information and a breakdown of some of the different areas that you're going to need to watch and some of the names that are going to be potentially in play. With that, I will let you guys get on to the afternoon trade, and I am always available for any feedback questions that you have. If there's anything that you thought I missed that you disagree with, I'm always interested in hearing your feedback, and we'll provide an ongoing commentary on this and the election process over the next couple of months, as you could well imagine. Thank you, everybody, and good luck trading in this afternoon period.